Thank you for joining me on It's Your Money. Whether you're here to learn about the basics of options trading or gain a better understanding of more sophisticated trading strategies like the Iron Condor or Iron Butterfly, you're in the right place. Because we're committed to creating easy-to-understand tutorials for all levels of traders, so make sure to subscribe to stay up to date. Today, we're going to explore one of the easiest and most well-known options trading strategies, the covered call strategy. Before we dive into the details of the strategy, let's start by reminding ourselves what a call option is. A call option gives the holder the right, but not the obligation, to buy an underlying asset, such as a stock or index, at a specific price, on or before a certain date, known as the expiration date. What is the covered call strategy? The covered call strategy is a popular options trading strategy where an investor sells call options against a stock they own to generate additional income. A covered call is when an investor who owns at least 100 shares of a stock sells a call option on that stock. The call options sold are covered because you own the underlying stock, and if the options are exercised, they can fulfill the obligation by delivering the stock. This is a good strategy for you if you believe that the stock price will stay relatively stable for the next few months. The covered call strategy has been used by investors for decades as a way to generate income from their stock holdings. If you were to use this strategy as a way to generate additional income, you need to understand, it also limits your potential profit if the stock price rises above the strike price, and the other individual exercises his options. In other words, if the stock price rises above the strike price of the call option, you may have to sell your shares at a lower price than what you could have received had you not sold the call option. However, if the stock price stays below the strike price, you keep the premium collected from selling the call option to another investor, and you can continue to hold onto the stock. Overall, the covered call strategy can be an effective way to generate income and manage risk in your portfolio, but it's important to understand the potential trade-offs and to use this strategy in the right circumstances. Understanding the risk associated with selling covered calls. You heard about a small gold mine in Nevada called Hycroft Mine, HYMC, from a friend. It sounded like a great investment. But before making any decisions, you did your research and found out some important facts. It may be a few years before the mine is actually profitable, which means there might not be much movement in the stock price for a while. The company's fundamentals looked solid. HYMC had a strong balance sheet with plenty of cash and a manageable amount of debt. They also had experienced management with a proven track record in the mining industry. You believed they had a strong CEO at the helm who had a clear vision for the future of the company. The chart showed Hycroft has a history of trading sideways inside of a particular range. With all this information in mind, you decided to buy 10,000 shares of HYMC at 50 cents. Now that you own the shares, you want to generate some income from them right now. After careful consideration, you decide the covered call strategy is what best suits you because you still believe in the company's long-term prospects, but want to generate an income from them right now. This strategy allows you to sell call options using your shares as collateral. And if the call options are exercised, you can fulfill the obligation by delivering your shares to the option buyer on the exercise date. Conclusion. Thank you for joining us today on It's Your Money to learn about the covered call strategy. In summary, the covered call strategy is a popular options trading strategy where an investor sells call options against a stock they own to generate additional income. The strategy can be an effective way to generate income and manage risk in your portfolio, but it's important to understand the potential trade-offs and to use this strategy in the right circumstances. With careful consideration and an understanding of the risks involved, the covered call strategy can be a valuable tool for investors to generate income from their stock holdings. Thank you for watching, and we hope this tutorial has been helpful in your trading journey. Please don't forget to hit the like button and subscribe for future updates. In our next video we dive deeper into options trading strategies you need to know. So subscribe so you don't miss a thing.